Hey folks, welcome back into our video series on controlling your taxes and minimizing your taxes in retirement with Roth strategies. I am Peter Richon, founder at Richon Planning, author of the book, Understanding Your Investment Options. Let's continue our discussion here on Roth strategies and how to control and minimize your taxes into your future. So far, we've talked about what a Roth is, the advantages of Roth IRAs, the opportunities to get money into Roths, whether through contributions or conversions. We've talked about strategies to maximize those contributions and conversions. Now let's talk about some basic assumptions in planning. With all planning, you are making some assumptions, and our plan is only as good as the assumptions are reliable, as the assumptions that we are making can be counted on and depended on. The assumption that you are making, that we've been taught to make with our retirement dollars, is that we will be paying lower taxes in retirement. However, nowhere is that actually written in the tax code. It's not set in stone. It's actually subject to change. And most retirees are finding that they don't have as many deductions as they had when they had a mortgage and they had children in the household. Many retirees are finding that they're actually paying as much, if not more, in taxes in retirement. Those same savers that started their career back in the mid-'80s, making $68,000 a year, they were in the 38% tax bracket. Today, in order to get into the 37% tax bracket, you have to be making more than $600,000 a year. So taxes have come down since that time. But from here, today, where we are now, where are taxes going to go into the future? That's an assumption, that's a paradigm that we may need to rethink, and many are. And that's why many savers and investors are being proactive in controlling and managing their taxes with the opportunities that we have today. Let me put this a different way. If you were to mail yourself an envelope of money, you were to seal the envelope today, put it in the mail, and mail it to yourself into the future, knowing that it was going to grow from the time that you mailed it to the time that you received it, how would you want that money to be taxed when you open that envelope? Well, I talked before about the three different classifications of money: taxable, tax-deferred, and Roth, tax-free. Let's talk about that assumption and what that envelope's going to look like when we open it. With the taxable envelope, we paid tax before we stuck the money in, and then when we open the envelope, we pay tax again on the growth. Doesn't seem like a great deal, paying tax twice and paying tax on each and every dollar. Now, with the tax-deferred account, your IRA, your 401k, what we have been taught to do, we stick that money in the envelope. We earned it, we brought it to our investment account, we sealed it in the envelope, we sent it to ourselves in retirement. We did not pay tax on that. We did not pay tax when we put the money in. We did not pay tax as it traveled through the mail and grew. But once we open that envelope, tax is due on each and every dollar as though it's brand new income at whatever the tax rates are at that time when we open that envelope. Now, in the tax-free Roth account, we pay tax once. We pay tax on the money when we earn it, and we stick it in the envelope, and then we mail it to ourselves into the future. And when we open it, all that money is tax-free to us, the original principal plus whatever growth has occurred. We can pull it out. The income is tax-free. If we don't ever use it, it passes to our next generation tax-free. So, what assumptions are you making in your planning? What envelope would you like to mail yourself that future money in? Do you think tax rates are going to go down into the future? Do you think they're going to go up? If you assume that taxes are going to go down and you're wrong, you have less money than you thought you would have. If you assume that taxes will go up into the future and you happen to be wrong about that assumption, then you end up having more money than you thought and anticipated. So you always have to carefully examine your assumptions, and it's also good to always ask yourself, well, what happens if I am wrong about these assumptions? So assumptions are made all the time in planning. Taxes, this is a pretty critical one to examine. So stay tuned. We're going to talk a little bit more about the sale that we are seeing right now on taxes, how to take advantage, and we'll talk more about that on our next video. So stay tuned, learn more about paying less in taxes.